a while ago. Basically, it was a cautionary tale. So I never did get into it, but um, I'll just provide what I got out of the info deep dive. So let's see what it's all about. It's about 30 minutes long or so. Okay, let's get this horse on the track.
Welcome to the deep dive. Today we're really zeroing in on a pretty intense question for anyone dreaming of financial freedom.
Which is
Can you actually hit mega success, like real consistent profitability, day trading crypto from your home office?
the big dream.
Exactly. And we're not just talking a little side income here. We mean aiming for the absolute top. What does that really take?
It's a powerful ambition, right? Driven by that idea of independence, making bank on those wild crypto swings.
For sure.
But let's ground ourselves immediately. The stats, they paint a very different picture across pretty much all day trading market.
Not just crypto, then.
No. Consistently profitable day traders are, well, rare. Figures suggest maybe only like 3 to 20% make consistent money.
Okay, that's already a small slice.
And the ones truly beating the market, maybe 1 to 3%. Tops, you mentioned that Brazilian study before.
Yeah, the futures traders were.
Right, something like 97% losing money. It's stark. And, even the SEC puts out warnings about how easy it is to lose big fast.
So that path to mega success is, well, it's incredibly narrow, statistically speaking.
Very narrow. And it's easy to get fooled by the success stories you see online.
That's that survivorship bias, right? You only hear from the winners.
Exactly. The winners shout loudest. The many, many more who tried and didn't make it, you don't hear their stories nearly as often.
Okay, so to cut through that noise, let's be super clear. What is crypto day trading fundamentally?
It's about high frequency trading. Buying and selling crypto within the same day, aiming to profit from those small short term price fluctuations,
And the key part.
closing all positions before the trading day ends. No overnight holds, no exposure to that overnight risk. It demands constant focus.
How's that different from, say, swing trading or just HO dealing?
Well, swing trading is holding for longer days, maybe weeks.
Yeah.
Trying to catch bigger price moves, those larger swings. And they do hold overnight.
Taking on that risk.
Right. And HO dealing is just, long-term investing. Buy it, hold it, believe in the fundamental value, ignore the daily noise mostly.
So day trading is definitely the most intense, the most demanding of the bunch.
Oh, absolutely. The constant screen time, the rapid decisions. It's a grind.
And the whole work from home dream gets tangled up in this.
It does. The idea of setting your own hours, trading this 24/7 market, it sounds great.
Liberating, yeah.
The flexibility is technically there, but that 24/7 market also means the risk never sleeps. You can trade anytime, sure, but the dangers are constant.
Okay, let's really dig into those dangers, those risks. If someone's aiming for serious, consistent profit, what are the big hurdles?
First up, volatility. It's extreme in crypto. Double-digit percentage moves in a day, even an hour. That's not unusual.
Wow, what drives that?
A mix of things. Pure speculation, big sentiment shifts from news or social media, regulatory talk, tech changes.
And sometimes just lower liquidity amplifying things.
Exactly. Then there's the regulatory landscape, or lack thereof, compared to traditional markets. That opens the door to manipulation, like pump and dump schemes. Leverage is another huge one. Tempting, but it magnifies losses just as easily as gains, often more so psychologically.
Need enough capital too, right?
Right.
To ride out the losses.
Absolutely critical. You need sufficient capital for proper risk management, for position sizing, and then there are operational risks, exchange outages, hacks.
Things outside your control.
Totally. And finally, don't underestimate the psychological stress. Constant high stakes decisions take a massive toll. It can break even skilled traders.
Okay, it's definitely not for the faint of heart. So, for those still determined, those aiming for that top tier of profitability, what are the absolute essential foundations, starting with the market itself?
You absolutely have to internalize the extreme volatility. It's not just a feature, it's the environment. Prices don't just drift, they can gap, spike, crash, often without clear warning.
Driven by all those factors you mentioned.
Yes, speculation, sentiment, news, regulation, tech, and sometimes lower liquidity in certain coins just pours gasoline on the fire.
And the 244th in market, how does that practically impact someone trying to trade consistently?
It means the market is always on. Opportunity and risk nonstop. If you're active, you need vigilance. There are no overnight gaps like stocks, but big moves happen 204/7.
Which sounds like burnout fuel.
It can be, absolutely. It demands a level of dedication, a lifestyle adjustment that many underestimate.
You also mentioned liquidity earlier. Why is that so critical for a day trader, especially one aiming high?
Liquidity is basically how easily you can buy or sell without, especially for day traders chasing small margins.
Yeah.
Trading less liquid altcoins, much riskier. Your own trades can move the price, the spreads between buy and sell prices are wider, execution is slower, it kills efficiency.
Okay, so grasp volatility, grasp liquidity. What about the actual mechanics? Spot versus futures.
Crucial distinction. Spot trading is straightforward. You buy the actual crypto, it's delivered to your wallet, you own it. Simple exchange.
Got it.
Futures trading is different. You're trading contracts based on the future price. You don't own the underlying coin. And crucially, futures often involve high leverage.
That double-edged sword again.
Precisely. For anyone serious about building consistent profitability, especially starting out, master spot trading first. It's generally the much safer, more fundamental path. Get profitable there before even thinking about leverage.
Makes sense. And placing the actual trades. The order types seem vital. Which ones are non-negotiable for a serious player?
You absolutely need to master the core three: market orders, limit orders, and stop loss orders. These are fundamental.
I'll write those down.
Okay, a market order says, get me in or out now. It executes immediately at the best available price. Good for speed, but you sacrifice price control and might pay higher taker fees.
Okay. Limit orders.
A limit order lets you set your price. I'll buy at X or lower, or I'll sell at Y or higher. Gives you price control, maybe lower maker fees, but no guarantee it fills if the market doesn't reach your price.
Right. Trade-offs. And the stop loss.
The stop loss market order is your safety net, your eject button. You set a trigger price. If the market hits it going against you, boom, it triggers a market order to sell or buy to cover if short. It limits your downside.
Essential for risk management.
Absolutely essential. Almost every serious day trade should have a stop loss defined before entry. There are fancier types, stop limits, trailing stops, OCOs, but nail these three first.
Right. Build the foundation. Okay. Market knowledge, check. Order types, check. What about the actual tools? What does a serious crypto day trader need in their toolkit?
Number one, without a doubt, is a top tier charting platform.
TradingView comes to mind.
Exactly. TradingView is the dominant player for good reason. It's got everything, tons of indicators, great drawing tools, different chart types, customizable layouts, and crucially, data feeds from pretty much every major exchange.
Plus that paper trading feature.
Invaluable. Practicing with virtual money, testing strategies risk-free, absolutely vital. There are alternatives, Coinigy, Go Charting, but TradingView is kind of the standard. You might need a paid plan for the really pro features and faster data, though.
Okay, so the charting platform visualizes everything. Where does it get the raw data?
From real-time data feeds, you need reliable sources. CoinMarketCap and CoinGecko are the industry standards here.
What do they provide?
Price, volume, market cap, supply info, historical data, pretty much everything aggregated from exchanges. Their APIs are also key if you're building custom tools or bots.
So you rely on the charting platform, but understand the underlying data sources.
Yeah, it's good practice. Verifying data, maybe finding more granular info sometimes.
And in crypto, news and sentiment move markets fast.
Yeah.
How do serious traders handle that?
Reliable news sources are key, but filtering is just as important. Stick to reputable outlets: CoinDesk, Cointelegraph, The Block, Decrypt, Blockworks, places like that. Use the news for context, understanding potential catalysts, regulatory shifts. But, and this is crucial for discipline, don't trade directly off headlines.
Avoid the knee-jerk reaction.
Absolutely. Be super wary of FUD, fear, uncertainty, doubt. It's everywhere. Use news to inform your analysis, not dictate your trades emotionally. Develop that critical filter.
So that's like these tools, charting, data, news, they all work together, right? An ecosystem.
Exactly. Charts visualize the data. News provides the context for why the data might be moving. Integrating these effectively is a massive step towards consistent trading.
Okay, foundations laid, tools identified. Now, the practical setup. For someone aiming high, aiming for that mega success, choosing the right exchange seems paramount. What are the absolute non-negotiables?
Top of the list, no question. Security. This isn't just a feature, it's the bedrock.
What does good security look like in practice?
Mandatory 2FA, verifiable cold storage for the vast majority of funds, regular third-party security audits, maybe even an insurance fund. A clean history regarding hacks and transparent handling if something did happen, Any whiff of sketchiness, run away.
Okay, security first. What's next for a high-performance trader?
Fees. They will eat you alive in day trading if you're not careful. You need to know the exact maker and taker fees for your main pairs, plus all deposit and withdrawal fees.
Be wary of commission-free claims.
Absolutely. They make money somehow, often through wider spreads, which can cost you more. Compare the total cost of trading, but don't sacrifice security or liquidity just for slightly lower fees. False economy.
And liquidity again. How do you judge that on an exchange?
Look at the 24-hour trading volume for the pairs you want to trade. Higher is generally better. Check the order book depth. Are there lots of buy and sell orders near the current price?
Why does that matter?
A deep book means you can get larger orders filled without causing huge slippage. Thin books, especially on smaller coins, mean your own trades can easily move the price against you. Not good for predictable entries and exits.
What about regulation? Is a regulated exchange better for a serious trader?
It's increasingly important, yeah. Exchanges complying with KYSAML rules in reputable jurisdictions generally offer more user protection and legitimacy.
Even if it means less anonymity.
Right, that's the trade-off. But it reduces the risk of the exchange suddenly facing legal trouble or vanishing. Check they're compliant where you are. It's a sign of a more stable, serious platform.
Any other practical points when choosing?
Sure. Asset availability, do they have the specific pairs you need? How's the UI UX? Is the platform stable? Intuitive? Does it have the charting tools and order types you need? Is the mobile app decent?
And customer support.
Don't overlook it. When things go wrong, and they sometimes do responsive, helpful customer support is worth its weight in gold. Imagine having a trade issue and getting no reply for days.
Nightmare fuel.
Okay.
Okay, so you do your homework, pick an exchange. What's the account setup usually involve, that KYC process?
Yeah, KYC, know your customer, is pretty standard now for regulated exchanges. It's about identity verification to comply with anti-money laundering and anti-fraud laws.
What do they typically ask for?
Your basics: full name, date of birth, address, phone, email. Then proof of identity, usually a government ID scan or photo, like a passport or driver's license, often a selfie or even a short video for liveness checks.
Proof of address too sometimes.
Yep, like a recent utility bill or bank statement. You submit it all, they verify it. Might be quick and automated, might take manual review. Some exchanges have tiers. More verification gets you higher limits.
A bit of a hurdle, but necessary for the better platforms.
Pretty much. It's the price of admission for accessing those liquid, more secure regulated exchanges that serious traders generally need. The truly anonymous options often lack the liquidity or reliability needed for active day trading.
Account verified. Time to fund it. What are the main ways, and what should a serious trader consider?
Common methods: bank transfers like ACH, SIPA, wires, often cheaper domestically but can be slow. Usually need the bank account name to match the exchange account name.
Okay, faster options.
Credit or debit cards.
Ah.
Very fast, very convenient, but usually much higher fees, and sometimes banks block crypto purchases or treat them as cash advances with extra charges.
Well, what about sending crypto directly?
Crypto deposits. Usually no exchange fees, but you pay the blockchain network fees. Speed depends on the network. The huge EE risk here is user error, wrong address, wrong network. Your funds could be gone forever. Triple check everything.
Any others? E-wallets?
Sometimes, yeah. PayPal, Skrill, etc. Availability and fees vary a lot by exchange and region.
So for a serious trader, what's the priority when funding? Speed? Cost?
It's a balance. You need agility, so funding speed matters, but high fees constantly erode profits. You need reliable methods that work consistently. Check the exchange's specific options, fees, processing times, and limits before you commit. Minimize that funding friction.
All right, okay, accounts live, funded. Now the core challenge, developing that trading edge, finding profitable trades. This seems like where technical analysis really comes in.
Absolutely. For a serious day trader aiming for high-level profitability, TA isn't optional. It's the primary skill set. It's how you read the battlefield.
Just to recap, TA is essentially
Studying past price charts and volume data, looking for patterns, trends, signals that hint at where the price might go next. The idea is market history, psychology, it's all reflected in the price action.
different from fundamental analysis, which looks at the project itself.
Totally different focus. FA is about long-term value. TA is about short-term price movement, which is the day trader's bread and butter.
So what are the absolute must-master TA concepts for someone aiming for mega success?
Deep understanding of candlestick charts is number one. Read the story in each candle open, high, low, close, recognize key patterns, hammers, engulfing, doji, stars. These are clues to market sentiment shifts.
Okay, candlesticks, what else?
Support and resistance, SR. Master identifying these price levels where buying or selling pressure historically kicks in. Understand how they act as floors and ceilings, and crucially, how they flip broken resistance becomes support, broken support becomes resistance. Vital for entries, exits, stops.
Trends.
Gotta read the trend. Up trends, higher highs, higher lows. Down trends, lower highs, lower lows, or sideways ranges. Draw trend lines effectively. The old saying, trade with the trend. It's usually the higher probability approach. Don't fight the current unless you have a very good reason.
Right. So price action first. How do technical indicators fit into a serious trader's toolkit?
Indicators add another layer of information. There are mathematical calculations based on price volume, helping gauge momentum, volatility, trend strength.
But not magic signals.
Definitely not. Think of them as probability enhancers, not crystal balls. The key for serious trading is using a few indicators you understand deeply and using them in confluence, looking for agreement between indicators and the actual price action. Don't just blindly follow one indicator signal.
Which ones are most essential for a consistently profitable day trader?
Moving averages, MAs, SMA, and EMA are fundamental. Identifying trends, dynamic SR, watching for crossovers like the Golden Cross or Death Cross.
Okay, MAs.
RSI, Relative Strength Index, crucial for momentum, identifying overbought, oversold conditions, and especially powerful when you spot divergence between RSI and price, often a clue for reversals. MACD, moving average convergence, divergence, another great momentum tool. Look at signal line crossovers, zero line crosses, and divergence again, very versatile.
Bollinger Band.
Yep, Bollinger Bands. Excellent for visualizing volatility. Look for squeezes where bands narrow often precedes a breakout. Can also help gauge if price is extended, though context matters.
And Fibonacci.
Fibonacci retracement levels. Not an indicator like the others, but a key tool. Drawing levels between swing highs and lows helps identify potential SR areas where price might pull back or bounce. Master why these work and their limitations.
Okay, with those tools, how do traders build actual strategies? What are some common, potentially profitable approaches?
Profitable trading needs defined strategies. Range trading is popular in consolidating markets, buy near support, sell near resistance. Look for confirmation within the range.
What about when price breaks out?
That's breakout trading. Entering when price decisively breaks a key SR level or pattern. Crucial to confirm with volume, watch out for false breakouts or fakeouts. Might enter on the break or wait for a retest of the broken level.
Trading with the trend.
Trend following. Identify the trend, then look for low risk entries during pullbacks, maybe to an MA, a trend line, or a fib level. High probability if done right.
What about scalping? Sounds intense.
Scalping is intense. Very short term trades, aiming for tiny profits repeated many times, needs high liquidity, tight spreads, fast execution, extreme focus, strict discipline. Much harder than it looks.
Any others? News trading, arbitrage.
News based trading tries to profit from volatility around news events, very risky, unpredictable. Arbitrage involves exploiting tiny price differences between exchanges, needs speed, low fees, multiple accounts. Less TA focused. Key is finding a strategy that fits you and back testing it rigorously.
Makes sense. Now, we know day trading leans heavily on TA. Does fundamental analysis FA have any role for someone focused on short-term serious profits?
It absolutely provides vital context. While you're not basing entries on FA, it helps you filter what you trade and understand potential catalysts.
Also,
Look at the white paper. What's the project's goal? Tech. Token use. Research the team. Are they credible? Experienced? Check the tokenomics. Supply, distribution, inflation. Gauge community sentiment. What's the actual use case or problem solved? What's on the roadmap?
so it helps avoid trading junk projects.
Exactly. And it helps you understand why a coin might suddenly move based on news related to its fundamentals. FA provides the bigger picture, the backdrop for your TA. Series traders use both, even if TA drives immediate decisions.
Okay, that blend makes sense. We've hit analysis, strategies, but you stressed earlier that none of it matters without solid risk management. For that mega success goal, just how critical is mastering risk?
If you're genuinely aiming for the top tier, consistent mega success, risk management isn't just important, it's everything. It's the foundation. It's what keeps you in the game long enough to even have a chance.
Because the market will hand you losses.
Guaranteed. Crypto is brutal. Without ironclad risk rules, you are gambling, plain and simple. The goal isn't avoiding losses, it's ensuring no single loss or even string of losses can cripple your account. Survival first, then profit. That's the mantra for longevity.
So, practical steps. Where does a serious trader start implementing that?
It begins with unwavering discipline in position sizing, calculating exactly how much capital to risk on each individual trade.
Based on account size and risk tolerance.
Precisely. The golden rule: risk only a tiny fraction of your total capital per trade. 1 to 2% is the standard recommendation for a reason.
Can you remind us of that calculation?
Sure, the basic fixed percentage method is position size in units, account balance times risk percentage, divided by entry price minus stop loss price. You need to know your entry and stop before you calculate this, and apply it every single trade.
Why is that strictness so vital for long-term serious profitability?
It achieves capital preservation. It means you can take multiple hits in a row, which will happen and still be standing. It forces risk assessment before entry. It removes a huge emotional variable. Honestly, disciplined position sizing is probably more important than having the perfect entry signal.
Okay, position sizing is foundational. The other pillar is the stop loss order. For the serious trader, how should they approach using stops?
Non-negotiable. A stop loss is attached to virtually every trade. It's your predefined exit for when you're wrong. It limits the damage automatically.
How do you place them effectively?
That's a skill. Common methods: just below key support for longs, or above resistance for shorts. A fixed percentage below entry, using volatility measures like the ATR to set a distance, placing it beyond a relevant moving average, or at the price level that invalidates the chart pattern you traded.
Finding that sweet spot, not too tight, not too wide.
Exactly. Too tight, you get stopped by noise. Too wide, the loss is too big. And the absolute cardinal rule for anyone serious: never, ever move your stop further away to avoid a loss. That's how accounts blow up. Accept the loss defined by your initial stop.
And remember, slippage can happen, right? The stop is a trigger, not a guaranteed price.
Crucial point, especially in fast markets or less liquid coins. Your market stop order might get filled slightly worse than your trigger price. Factor that possibility in.
Okay, let's quickly revisit leverage and margin. For someone aiming high, what's the realistic take on using it?
Extreme caution. For someone serious about consistent profitability and staying in the game long term, avoid leverage entirely when starting. Master profitable spot trading first,
Why such a strong warning?
because leverage magnifies everything, especially losses and psychological pressure. A small move against you with high leverage, instant liquidation, your margin is gone. Poof,
The liquidation price gets closer with higher leverage.
much closer. Less room for error. Plus, you pay funding rates on leveraged positions, another drag on profit. The overwhelming consensus among pros: beginners shouldn't touch it. It just speeds up the process of blowing up an account if you haven't nailed risk and emotions.
So if someone becomes consistently profitable on spot,
Maybe, cautiously, consider very low leverage, like 2x, maybe 3x max, but only with even stricter risk management and full understanding. It's adding fuel to the fire. Make sure you can control the heat first.
got it. Okay, technicals, risk.
Yeah.
Now the mental game, trading psychology, you said this is often the real differentiator for serious success.
Absolutely. It's arguably the hardest part. You can have the perfect system on paper, but if FOMO, FUD, greed, or fear makes you deviate from it when real money is on the line,
Yeah.
your system is useless.
What are those common pitfalls again?
Oh man, FOMO chasing pumps, FUD panic selling dips, greed not taking profits, over leveraging, fear cutting winners short, missing good entries, overconfidence after wins leads to sloppy trades, loss aversion holding losers hoping they guys. Discipline is forcing yourself to follow that plan, guys. Discipline is forcing yourself to follow that plan no matter how you feel. Patience is waiting for setups that perfectly match your plan's criteria, not forcing trades that aren't quite right.
And the trading journal fits in how?
The journal is your feedback loop. You meticulously log every trade: the setup, why you took it, entry, exit, size, and critically, your emotional state throughout.
Why log emotions?
Because reviewing it later shows you where your plan broke down and if emotions were the cause. Did you revenge trade? Did FOMO make you jump in? Did fear make you exit early? The journal exposes your psychological weaknesses so you can work on them. Plan sets the rules, journal tracks reality, review leads to improvement. Essential for mastering the mental game.
Okay, massive amount of prep work, understanding markets, tools, risk, psychology. What are the very first practical steps someone should take before putting serious capital at risk?
Start with paper trading. Seriously. Use a demo account with virtual money. Do it for a meaningful period.
What's the main goal there?
Get familiar with the platform. Practice executing your strategy exactly as planned. Test your entry exit rules. Practice your risk management, your position sizing. Build process discipline without the fear of losing real money yet.
Which platforms offer good paper trading?
TradingView has it integrated. Binance has mock trading on their futures testnet. Kraken has a demo for derivatives. Plenty of options.
What's the big limitation of paper trading, though?
The lack of real emotional consequence. It doesn't feel the same as having your own money on the line. That's the big caveat.
So how do you make it useful?
Treat it dead seriously. Follow your plan rigidly. Journal every simulated trade as if it were real. Aim for consistent process execution and gather performance data on your strategy. Validate it works on paper before going live.
Okay, you've achieved consistent results on paper. What's the smart way to transition to live trading?
Very, very carefully. Start small, and I mean really small. Use an amount of capital you are genuinely okay with losing completely, like $100, $200, maybe $500 max, depending on your situation.
Why start so small if the strategy worked on paper?
Because the psychology changes instantly when real money is involved. Your first goal live isn't profit, it's surviving the emotional shift. It's proving you can execute your exact same plan under real pressure.
Stick to the same rules, same position sizing relative to the small account.
Absolutely, no deviations. Manage your emotions. Track everything in your journal. Only after you demonstrate consistent profitability and process adherence with that tiny stake over weeks or months should you gradually consider increasing capital and position size.
Bridge that paper to live gap slowly.
Exactly. Starting small makes the inevitable early mistakes less costly while you adjust to the real pressures.
Okay, brings us full circle. We've gone deep into the mechanics, the risks, the mindset. So the big question again, crypto day trading from home, is it a viable path to mega success and consistent profitability? What's the final realistic verdict?
Look, is it theoretically possible? Yes, maybe for a tiny fraction of people. But is it a probable or reliable path, especially for beginners aiming for mega success? Absolutely not. The odds are heavily, heavily stacked against you.
Why so definitively negative?
It requires this rare convergence of substantial capital, highly advanced skills that need constant updating, a massive time commitment, like a very demanding job, exceptional psychological discipline, ironclad risk management, and frankly, a high tolerance for stress and potential failure.
So it's far from the easy money dream often portrayed.
Worlds apart. You're competing against professionals, algorithms, institutions with huge advantages. Factor in transaction costs, potential platform issues, taxes. It's an incredibly challenging arena to consistently extract large profits from. It's high risk speculation, fundamentally.
Are there better alternatives for people looking for home based income or crypto exposure?
For many, yes. Things like swing trading might be less intense. Long term investing, HO dealing based on fundamental research is a different game entirely. Exploring staking or other yield generating DeFi activities, or even developing related skills, blockchain development, content creation in the space. These might offer more sustainable paths for many.
So the final takeaway message is
Extreme caution. Understand the reality, not just the hype. If you do venture into crypto day trading, treat it as high stakes speculation. Only use capital you can truly afford to lose your risk capital. Prioritize education, rigorous risk management, and psychological resilience above all else. The dream is tempting, but understanding the brutal probabilities is key to not wrecking yourself financially.
that's it. So check if anybody texted or wrote messages, and that's it. Nobody. All right, this has been Military Industrial Museum. Nobody subscribes anyway, so I won't ask you to, but nobody liked it, so I won't ask you to. Get gone, because I am.